CP 1025, released by the PRA, has been a hot topic amongst our partners and members.
It's a meaningful piece of documentation from the PRA, and I think what it represents to the market is that it is a maturing of the position.
It's a signal that lenders and banks need to take climate risk much more seriously, move it beyond being a tick box exercise to being a meaningful part of risk management and decisioning.
The PRA now wants to see firms, embedding this within their climate risk. They need to embed climate stress testing into their existing processes, and they need to try to address data gaps while maintaining some credible assessments.
So I think the key thing to do the P1025 justice is actually to have very good quality data. The critical part of it is, what does that data look like and where do you get access to it?
For too long, we have been looking at climate risk as a separate exercise to lending, decisioning, credit risk, and ultimately we need to bring the two together.
Climate risk data is different to normal credit risk data. Credit risk data is built on precedent, whereas climate risk data is based on what will happen in the future. Now that makes it a challenge to just look for where has climate change had an impact on, and then extrapolate that into a credit score. It doesn't work that way. So we need to think differently about how we integrate the two together. And that's a challenge that we're working alongside lots of different lenders to try and help them with that conundrum.
I think it's a challenge in terms of what data is out there, what level of granularity can we achieve? But then when you actually get to asset level, which is really the direction we want to go into, that's becoming increasingly obvious that we need to probably refine the data and make it better. But that's really hard.
I would say probably the biggest data gaps fall under two areas. One is getting the granular data. Most banks tend to look at risk from a sectoral level. So they split the economy into a dozen or so sectors. So every hotel, restaurant, spa, golf club falls under hospitality and leisure. And as we know, those businesses are incredibly different. So getting an understanding of the risk at a granular loan level, that's something that's going to be a real challenge for many businesses.
It's a very mixed bag. Everyone's doing slightly different things. This is a data challenge, and most banks, their main skill set is not wrangling with data.
At banks, or financial institutions, we do have access to probably the leading line of data and how we decarbonise our business, which is great. But the truth is, there's a lot of businesses out there that don't have access to that.
Part of it is getting the data from the SMEs, and that has been, definitely a big challenge.
I think there's a misconception that people think that you can just ask a customer, tell me your carbon footprint. There's no such thing as a little meter somewhere that people can get.
And then part of it is trying to look at what external data sources we can potentially use to help provide us or help to fill in some of those gaps.
What's critical here is that there is a way in which the standardization and the tools are needed.
Whilst this is a data challenge, actually this is about how data informs lending and decisioning and becomes a core part of the financial ecosystem.
At the heart of it, this is a data challenge. We have technical risk data on one side, and we need more of that, and we need to get that being applied to lenders' assets.
At the end of the day, these risks, they're real, and we're not in a situation now where we can project that far into the distance. Already 2025, so absolutely I think these decisions and data fundamentally do need to be part of influencing those credit decisions.
I think at Oak North we're in a very fortunate position because this is something we've been doing since early 2020. We've split the economy into about 274 different subsectors, so we go down to the individual loan level. And what that means is that for every business, every SME that we work with, we're able to say, okay, where may the opportunities be, even if the business themselves hasn't considered it.
We're fortunate in the sense that we do operate in a motor market which is pretty well supported with data. In property, so again, we've got quite good data through EPCs there, but it's more the individuals and the clients, and how do we help translate that into meaningful action?
We have something called the Climate Decision Framework, and this is where we collect that data, but collect that data also in engagement with customers. Through that conversations and understanding those actions, we'll have a much better idea of what the risk but also the opportunity can be with customers. So that impacts our lending decision in that way. And that kind of identification is working with customers to turn possibilities into progress, rather than seeing this just as a risk management exercise.
You know, one of the interesting things is banks have thought we have to create a new product in order to service these customers. I think actually it's about saying how can we apply the existing offering and the existing products and think about how we can use those to support customers in the transition.
I think we would be wrong as an industry to assume the data we have today is the perfect answer or the best answer. I'm sure the data we have today will be, you know, hopefully eclipsed in 5-10 years, and it needs to be. I see that as beholden to everyone. And it's really important that we work with good partners and good suppliers of data so that they can make our lives easier, and then we can hopefully make that difference to intermediaries and customers.
Quality of data is so important because quality of data links directly to quality of decision.
The future of climate risk in lending is going to be much more proactive and data-driven.
The future of climate risk in lending is having that data available in every decision.
The future of climate risk in lending is pragmatic. I don't think it will work any other way.
The future of climate risk in lending is that it actually reveals the true risk in our credit decisions, our capital allocation decisions, and our risk-weighted assets in our portfolios.
The future of climate risk in lending is fully integrated, and it's coming sooner than you think.